I started investing when I was just 11 years old. Before that, I was just experimenting, playing around with numbers, trying to make sense of the market. But my real journey began at 11, and I spent the next several years testing different investment strategies, market timing, stock charts, all sorts of complex techniques. Honestly, it was fun but totally unprofitable. For years, I searched for the ultimate formula, something that could give me an edge. I devoured every investment book I could find in the public library. But the truth is, I didn't have a structured approach. I was just hoping I'd discover a secret pattern that could predict stock movements. I even tried flipping stock charts upside down. But guess what? That didn't help either. Then, in 1949, I came across a book that changed everything. The Intelligent Investor by Benjamin Graham. At that moment, my entire investment philosophy took a 180-degree turn. There are just 2 key chapters in that book, but they transformed my mindset. They shaped the way I think about investing forever. The 3 golden rules of investing. A stock is not just a ticker symbol, it's a business. Many investors look at stocks as mere symbols or price movements on a screen. That's the biggest mistake. Instead, think of each stock as a piece of a real company. Before you invest, ask yourself, what does this company actually do? How does it make money? What's its competition like? Who runs the company? Are they smart and trustworthy? When I was young, I memorized all the stock ticker symbols of companies on the New York Stock Exchange, but I had no idea what those companies actually did. I only focused on price movements. That was foolish. The moment I started seeing stocks as real businesses, my investing strategy changed completely. 2. The stock market is your servant, not your master. Graham introduced a brilliant concept, Mr. Market. Imagine you have a business partner who offers to buy or sell your shares every single day. Sounds great, right? Well, here's the twist. This partner is completely unpredictable. One day he's overly optimistic, offering you ridiculously high prices. The next day he's depressed, selling at dirt cheap rates. Now, if you took him seriously every single day, you'd go crazy. But here's the secret. You don't have to listen to him. You only pay attention when his price is in your favor. That's exactly how the stock market works. Prices fluctuate wildly, but a company's actual business doesn't change overnight. Smart investors stay patient and wait for opportunities. You don't need to trade daily. You just need to strike when the opportunity is right. 3. The margin of safety. Principle. Imagine you're driving a truck that weighs 9,800 pounds across a bridge marked maximum capacity 10,000 pounds. Would you risk it? Of course not. You'd find a safer bridge. The same principle applies to investing. Never buy stocks that are priced too close to their true value. You want to buy them at a discount, a margin of safety. If a stock is worth $100 but is trading at $50, that's a great margin of safety. But if it's worth $100 and trading at $98, there's no safety at all. Investing isn't about hitting home runs every day. It's about minimizing risk while maximizing returns. How to find the best investments. If I gave you $1 million and told you to buy any 3 private businesses in your city, but you had to own them forever, what would you do? You wouldn't just buy any random shop, right? You'd search for businesses that have a strong competitive advantage, something that makes them unique and hard to beat, a trustworthy and competent management team, a fair price. You wouldn't overpay. That's the exact mindset you need when investing in stocks. The best businesses have a moat, something that protects them from competitors. For example, Coca-Cola. Their brand is so powerful that people instantly associate it with happiness and celebrations. Even if a competitor spends billions on advertising, they can't erase Coca-Cola's brand image. Patents and unique products. Some companies hold patents that prevent competitors from copying their technology. If a company has a strong moat, it can survive for decades, even through tough times. The number one investment mistake people make: most people overreact to stock prices. When prices go up, they feel excited and buy more. When prices go down, they panic and sell. That's the wrong approach. Stock prices don't know you own them. They don't care about your emotions. The market doesn't exist to guide you. It exists to serve you. Instead of chasing trends, focus on understanding the business behind the stock. If you can master that mindset, you'll be far ahead of most investors. Final takeaway: the secret to long-term wealth. You don't need to invest in 100 different stocks. You only need a few great ideas in your lifetime. If you were limited to making just 20 investments for your entire life, would you still waste money on random stocks? Of course not. You'd be extremely careful, choosing only the best investments. Invest in great businesses. Ignore short-term noise. Buy with a margin of safety. That's the real secret to long-term wealth. And that's exactly how I built my fortune. Want to learn more? Subscribe for more investing wisdom, and I'll see you in the next video.